Yo, what's up, guys? It's your boy, Looney. Tomorrow is a huge day. The Fed is set to announce its rate cut decision. And as of now, we are looking at a 25 or maybe even a 50 basis point cut. But I want to step back and look at the big picture of what markets actually have done historically after the Fed starts cutting. But before we get into this video, I want to give a shout out to the Discord. It is free to join, and then I also offer a premium membership that's $8 a month, and that gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links that are in the description. But as we talk about the rate cuts, let's actually pull up the prediction market, because you could actually pretty much gamble whether you think they will cut rates. And that's exactly what I did. I put $770 betting that they will cut the rates by 0.25 or 25 basis points. And if I do win that, or that actually happens, I get $1,100. And as of now, it's about a 92% chance of that happening. So other markets might have it differently, but as of now, it's around that 92%. And therefore, things are looking pretty good on my sort of gamble. But let's just rewind a little bit, because in every cycle since the 1970s, 1 year after the first rate cut, the market has actually been higher a year later, literally 100% of the time. Now, again, this doesn't mean that this time is going to be the same, but history does show that rate cuts tend to fuel growth and support equities over the following year. And that's why you hear so many traders saying bad news is good news. Because as of now, we are seeing rate cuts, and a part of it is due to bad economic data. We saw bad job data, and the Fed is having to step in to stimulate the economy, and lowering interest rates helps do that. And although it does raise inflation, which isn't great for the economy, it does help the stock market, where equities and other risky assets actually start to grow or become more appealing. But that's on the 1 year chart. And you might be thinking, if that's the case, why not go all in right now? And that's why I want to also look at the short-term outlook, because the short term could look a lot differently. And this is where we actually need to pay attention to what Powell has to say, because essentially the rate cut decision isn't really the most important thing, because that is essentially priced in. You can see here 93% chance of the rate cut. So that rate cut decision has already essentially happened. That's a big reason why the market has actually been doing really well these past few weeks, along with other reasons. But the rate cuts actually probably happening tomorrow is a big reason we are seeing the market run hot. But after they make the rate cut decision, they usually talk. So Powell comes out and he decides, or he talks either dovish or hawkish. Dovish means that he's hinting at more rate cuts down the road, and this could actually explode the market higher in the short term. And he might say that we might get rate cuts in October as well as December. I believe those are the two meetings. And if he hints at that, that is really bullish for the markets. And they could basically say they're set to do this. But on the other hand, if he's hawkish, meaning it's just probably that one and done scenario, they're just going to do this one rate cut and then go back to its normal ways, and he's actually worried about inflation and he doesn't want to do any more rate cuts, then we could see a sell the news event. So I'm not making major moves on this decision tomorrow. I'm really just trying to react to the market. So the markets have basically already priced in tomorrow's cut. So a hawkish tone could actually spark a quick pullback. But you can see here, I am essentially ready for any scenario. If the market runs higher, I did buy up a open position, and this is a risky asset. So if the market does well, this stock should do well along with it. It's very hype driven and risk on environment. So this is the type of stock that should do well if we do see the market actually go upwards. Now, another way I am actually ready for the upside is this IPO. So there is an IPO going on tomorrow for StubHub, and it's basically reselling tickets and the ticket marketplace for sports and concerts. You guys have probably seen it before, but I have queued up for 333 shares for this IPO dropping tomorrow. And I probably won't get filled all these shares. I'll probably get some of that refunded back. But this is one of those IPO plays that I plan to just be in and out in the same sort of day and just make a quick buck. So if the stock actually runs, or the market runs hot tomorrow and goes upward, this is a type of stock that should do well, especially on IPO. IPOs usually do really good on its first day, and then they begin to fizzle out the next few days. But that's where most of my cash is locked up. Now, you might be thinking, what is my preparation for the downside? And there's a couple ways I'm doing the downside. I have a bunch of covered calls going on for my stocks that I own. That's I wouldn't say a bearish strategy, but because my covered calls are so deep in the money that they are a hedge, essentially, if the stock or the market pulls back a lot. So yeah, a lot of these Riot calls and SoFi calls are really deep in the money, and I'm constantly rolling them. But if we do see the market pull back, these should give some breathing room and actually help my portfolio a little bit correct itself. And then again, remember, I do have cash. So the cash I have locked up in the IPO, I'm sure I'm not going to get all that. So I'm going to get a lot of that returned back to my buying power. And also, I have cash secured puts on Mara. I have $4,000. And as of now, these are out of the money. So I will have $4,000 back into my buying power. And I believe I have another one on Oscar, and this one is only $1,300. So about $5,000 locked up in cash secured puts. And the way it's looking, these ones I should expire worthless and should get my cash back. So you can see I'm definitely prepared for both sides, whether we go upwards or downwards. I personally would actually like to see a downwards direction, hopefully a buy the dip kind of scenario. And that's something that I want. I'm not sure if that's going to happen. I am okay with that, but I am looking at it. But also later this week, this is pretty interesting, is we have triple witching. And that's when stock option, index options, and futures all expire at once. And it only happens 4 times a year. And it usually does bring a ton of volatility. So September historically has also been a bad month for the market, but between the Fed decision tomorrow, the StubHub tomorrow as well, and triple witching on Friday, we have a lot of things going on these next few days. And this is definitely set up to be one of the most important trading weeks of the year. So just to summarize, for me personally, I'm staying hedged with my covered calls and some cash on the sidelines. But I'm also playing the upside with some of my speculative plays with open and IPOs. I also have some spreads as well, but no matter which way this breaks, there is going to be opportunity. So 1 year after first rate cut, markets have always been higher. Keep that in mind. But in the short term, depends on Powell's tone tomorrow, whether he's hawkish or dovish. Pair that with IPO season and triple witching, and this is going to be a very interesting week. Until next time, peace.